Welcome, Fortune Builders community to your monthly passive income club continuing education. I'm your host this evening, Pablo Gonzalez. This guy right here, I affectionately like to call him GC because he's got these like genius concepts. Dude knows how to generate cash flow. He's a great co-host and his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
It is great to be here with the Passive Income Club to talk about something that really matters when it comes to passive income and investing in buy and hold rental properties. And it's the best markets to invest in 2025. GC, I feel like when people think of investing in rental properties, that's all they think about, the property.
Right.
Right. And while the property is the widget. Normally, when you buy a widget from a company, you're not so concerned about the widget itself as much as the company that has it, right?
Mm-hmm.
And when it comes to rental properties, that company is based on basically the operator, and then there's this invisible force, right? This like thing that can really like tank you or not tank you, and it's the market that it's in, and people just don't pay enough attention to it. Is that your experience?
You know what? The right market literally can be $1 million decision, especially if you are somebody who is building a portfolio of rental properties. But most investors have no clue. They don't look any farther than their own backyard to make an investment decision in rental properties. Mm-hmm. And ultimately, what a lot of investors do is leave hundreds of thousands of dollars or even millions of dollars on the table over a full market cycle. So we thought of that. We knew that. We know that because we manage all of these rental properties here in Jacksonville, Florida. And we said, how can we help the Passive Income Club learn what most investors never learn? How to choose the right market to invest in from a completely objective, fact-based, systematic perspective. And so that's well, we came up with this, and I hope you guys are going to enjoy it.
That's why Paul invited us over here to take the mic and do it. I love y'all checking in the chat. Monica coming from Palm Desert, California, beautiful little part of the world. Charleston, South Carolina. Michelle Anderson, just up the road from us here at JWB.
There we go.
Antonia Gray Fenton from New Jersey. Nicole Martinez from Maryland. Welcome to the show. Keep checking in. Let us know where you're from. We want this to be, well, I think I might be sharing the wrong thing here. We want this to be as interactive as possible. There's a Q&A function. But GC over here put together this presentation that we're going to run through for you. Trupti Perrick from New Jersey.
All right.
Duvi Joshi from Austin, Texas. I love Austin, Texas. I know you love Austin, Texas.
I was just there.
Mauricio Salcedo from West Palm Beach. Teresa Elwood. Oh, Stephen Teresa from St. Johnsville, New York. That sounds interesting.
All right.
Manval Taylor from Brooklyn, New York. Francisca Petrescu from New York. A lot of New Yorkers.
3 in a row.
A lot of New Yorkers.
We love our New Yorkers.
All right, Eduardo Jurado from Houston, Christine Delgado from Colorado. I love it when y'all check in. All right, we're going to get into this to make the best use of your time. Carlos Baron from Whittier, California. I see you, buddy. All right, so that being said, this is financial education, right? We are not financial advisors. We are using real data that's come from the past, but this is not a prediction from the future. And this is for your informational purposes. Make sure that you do your own due diligence and stuff like that. GC, did I miss anything there?
I'm not a financial advisor. Neither is this my esteemed colleague over here. This is not financial planning advice. And when you are thinking about making a decision of this magnitude, surround yourself with people who you trust.
Got it. We got to say that. That being said, you have surrounded yourself with a bunch of folks that you trust. This is why you're part of the Fortune Builders community. JWB is an extension of the Passive Income Club. This is a 18-year, 20-year, 18-year?
Yeah, 100%.
18-year relationship that JWB has had with Paul and Than and everybody else. And we are here for you. This is included in all your services. JWB will give you a consultation and draw out an investment plan for you for passive income through single-family rental properties if you give them a call at 904-677-677. If calling is not your thing, maybe you're a millennial like me, you just want to text, go to 904-293-0341. Or if you want to just pick your own time and place and not have to go back and forth, go to jwbrealestatecapital.com/FB, which is short for Fortune Builders, because this relationship has been here for a long time. GC, you want to tell us about the meek origins?
I do. I do.
Why Paul gave you the bike?
You want to know the best part of preparing for this presentation? I went back into the annals of my phone to go and find old pictures from when we started and from when I got to meet Than and Paul and the Fortune Builders team. For those of you who don't know, I was Fortune Builder student number 1.
Oof.
I was the very first Fortune Builder students before there was ever even a Fortune Builders. And that picture on the top left there, that's my business partner, Alex, and myself at the very first conference that I met Than and Paul and Conrad. And, you know, that relationship really kicked off in a sense. It totally changed the trajectory of my career, my life, by meeting Fortune Builders, by meeting Than and Paul. And, you know, I just knew that I wanted to be like them in terms of my real estate career. I saw a business. Go ahead. Did you have something?
Well, I was just going to say, I can't help but notice how much darker your hair was.
How about that, huh? You want to know something funny? I've been to many Fortune Builders conferences. I get to speak at them and whatnot. And I walk down the hallway, and you would be surprised at the number of folks who come up to me and say, "Hey, Than, how you doing?" People literally mistake me for Than, a much less strapping version of Than.
Because of your athletic abilities?
You know what? I'll take that. I'll take that. I mean, Than played in the NFL. I'll take that. Man, that is hilarious. So our relationship started, you know, 20 years ago.
Yeah.
And it is the greatest thing that happened to us in our real estate career. It's been 20 years of helping Fortune Builder students be able to invest in single family rental properties. And we're honored and we're blessed that Than, Paul, Conrad have given us that recommendation for Fortune Builder students to invest with us. We don't take it lightly. It's something that we hold very dear. So we're excited to be here with all of you. This relationship has been many years coming, or many years that it's been built. But I also want you to know that I remember what it's like to buy your first rental property. You know, I've bought many over the years, but I love that picture there at the bottom left there. That's my business partner, Alex, sleeping in the office. We're all entrepreneurs on this call here. We all know what it's like to start something from nothing, and the amount of hard work and the courage that it goes into, whether that's building an active business or your passive business or buying your first rental property. So I know what it feels like. I hope this call gives you the courage, gives you the information you need to be able to take that step forward. You know, there's our first check that we received, you know, that, and I'll tell you, once you do your first investment, it doesn't matter how much money you make. The conversation you have with yourself, which is like, I did it, it changes the trajectory of your life. So thankful for the Fortune Builders relationship. I'm thankful to be here with you guys today and hopefully to bring a lot of value.
Yeah, I like you framing every real estate investor, whether you've started or not. If you've taken this leap into Fortune Builders and what you're doing, you're an entrepreneur. You're investing in your own future, taking control of your financial future into your own hands. That is an entrepreneurial endeavor, Greg. And I have to assume that the investment that Than and Paul and those guys made in you guys makes them pretty proud, right? Like it's not just shown by them handing over the mic, but for me, I'm an entrepreneur myself. I started this marketing business. I got to host this. For the last 5 years, I've been hosting this podcast with Greg and doing marketing strategy for these guys. And all I've gotten to see is one of the most impressive companies that I have ever seen the guts of, right? Like what you and your partners have built in JWB Real Estate Capital, where you manage 6,000 properties for people, where you employ over 100 folks here in Jacksonville. Those are just like, you know, I think you're like a $200 million company with more than $1 billion assets under management. Those are all stats that don't tell the picture of what I've seen here of a world-class team with a world-class culture, with people that make you feel good. Whether you're on the West Coast, it's kind of like going to an In-N-Out burger. If you're on the East Coast, it's kind of like going to a Chick-fil-A. You walk in here, you're like, who are these people that are making my day better? I just want a burger, right? Like, but no surprise, you guys have won these Best Places to Work awards. You won an EY Entrepreneur of the Year award, all these Inc. 500s, right? Like everything that you've grown and what you're doing, and now really city building. You've become these like pillars of living in Jacksonville. I see what you guys are bringing to the community. I think it's really impressive. And I'm just very impressed.
Well, thank you for saying that. A couple things just to take note of. Number one, this business that we've built has been the model of Fortune Builders. Their imprint, the Fortune Builders way, is all over JWB. And it first starts with building a dynamic team. So, you know, this is 20 years of work of literally putting into practice what we all have learned through Fortune Builders. So it's a testament to the success of the program as much as a success for us here at JWB. And then the other thing to take note of, guys, is I own over 400 rental properties, and I share that with you. I still own those today. I still add properties to my portfolio. I want you to know that I know the highs, the benefits of owning a portfolio for a full market cycle now, and I also know the pain points, and I get to help inform those others of those potential pain points before you start to invest, how to avoid them, and that's really what calls like this are all about.
Got it. So let's get to the meat of the conversation here, GC. You got all these 120 people ready to help the rest of the Fortune Builder community. Let's help them make some great decisions about markets. That being said, if you are just getting into rental properties or you've been doing it for a while, this is a really core concept, right? This idea that rental properties, to really get the most out of buy and hold, passive investing, rental income properties, you need to understand that they pay you 5 different ways. There's 5 profit centers in rental property investing. It took me about a year and a half to actually get this through my thick skull. But what I've come to understand is that most folks really just think about cash flow.
Right.
And because of that, they're kind of like tripping over pennies. They're tripping over pennies to get to
Stepping over dollars to pick up the dimes.
Yes.
There we go.
I speak for a living. So that being said, they're stepping over dollars to get to, they're tripping over dollars to get to the pennies.
They're doing something, but it's not profitable.
There's something about a good look at a T-bone out here. That being said, right, the 5 profit centers of rental property investing, there is cash flow. Cash flow is important. We call cash flow the entry to the dance, right? You want to be at least at like net positive cash flow year 1 so that it doesn't become a terrible experience and it becomes scalable. You're not just going into your coffers. That gets really, really risky if you're doing that with your active income. Then there's tax savings. The idea that you can depreciate your asset in a way that allows for you to keep that that cash flow at the end of the year is a really, really big deal. Principal pay down, this is your rich Uncle Rico paying down your credit card debt, except it's your resident that is living in a home, paying down a bank loan that you took out to buy that home. It's kind of like a really high floor that makes this great. Then there's home price appreciation, which we're going to get much more into, but obviously the idea that home prices go up over time, while in small windows that can be challenged, over a full market cycle, it's undefeated. If you take a look at 10 to 20 year market cycles, home price appreciation is like clockwork. Each market has their own rhythm of the clock, and that's really, really important. And then there's inflation hedging and profiting. Those have become a big thing in the last couple of years, especially as we see a more inflationary times. And this idea that if you have $1 under your mattress, tomorrow is worth less because the price of goods are going up around you. That doesn't happen with homes, right? Like the replacement value of your windows and your walls and your roof will go up with the prices of it. So that hedges against inflation. And then there's the idea of profiting off of it. The idea that when you take a loan today, 30 years down the line, you're paying off tomorrow's prices with today's dollars. It's kind of like if you could have locked in this idea that a cheeseburger used to cost a nickel when I was a kid, and you were still paying a nickel for cheeseburgers 25 years later because you did this. Kind of like that.
There you go. You did great, man. Nice rundown.
I've done this a couple times, GC.
You have.
Done this a couple times, GC. That being said, GC, I think everybody wants to know who's number 1. What's the profit center that takes the most?
And this is why this review and refresh is so important. It's because there is one profit center that makes more money than any other profit center, and it's not even close. And it's home price appreciation. And we call it the Pac-Man principle because I get to analyze over $1 billion of real estate. All of our clients, many of our clients are on the call here today. All of our clients, I get to see how they actually make money over a full market cycle in rental properties. And we call it the Pac-Man principle because it looks like a Pac-Man. Home price appreciation is always eating the other profit centers. And home price appreciation is predictable based on which market you choose. So if we know it's going to contribute the most wealth to you, and we know that it's predictable, this show is about helping you maximize all 5 profit centers and certainly keeping an eye on home price appreciation to deliver the most wealth for you.
Got it. And this is a pie chart that we go over show after show. We've done over like 400 episodes of what we call the Not Your Average Investor Show. And what you consistently see is that home price appreciation accounts for 60 to 80% of total returns. This is a perfect example, right? Like rental income is over here, tax savings is here, principal pay down is here on the pie chart. This big piece that looks like the Pac-Man itself and everything looks like the mouth, that's home price appreciation. And we see it over the 20 years that Gregg has been doing business, portfolio after portfolio, whether you invested with cash in 2006 or with a loan in 2019, you kind of see this trend. That's why we called it the Pac-Man principle, because it looks like a Pac-Man. All right.
There you go.
Right. Whether it's mouth open or mouth closed, looks like a Pac-Man. And I think the big lesson here, GC, is the idea, when I say tripping over dollars to pick up pennies, is that if you're focusing on, if you're focusing so much on cash flow only and you're not thinking about this home price appreciation piece, then you're really missing out on the biggest piece of the pie.
Exactly.
And that is mostly correlated with markets to invest in.
There you go.
Right? So this guy, I call him Genius Concepts for a reason, is because he likes to come up with these like criterias, these rubrics, these kind of like shortcuts to understanding what to get to. And he's put together the 6 criteria for determining the best rental markets in the U.S. GC, I'm going to put this little slide up that you put together. Why don't you talk us through it?
I love it. So for this training, I wanted to put myself in the shoes of a brand new investor who had a blank slate of where they wanted to put their money and how would I go about it. And there's some criteria that I put together here. And the thought here is, listen, there's 1,000 billion markets in the country. How could I focus in on the ones that are potentials that I should spend even more time investigating? And how could I eliminate the 98% of other markets out there? Mm-hmm. And so that's what this criteria will help you do. We're going to look at rent to price ratio, current population size, home price appreciation rate over the long haul. We're going to look at population growth, median income growth, and we're going to look at median home sales price. And as we go through these, what these are doing is it's either helping you understand how much cash flow you're likely to receive, which is something like rent to price ratio or median home sales price, or it's helping you understand how much growth you're going to receive so that you maximize your Pac-Man principle. Mm-hmm. Or it is a future indicator, what's likely to continue to happen going forward. That's what these 6 criteria allow you to do.
Love it, GC. So rent to price ratio, current population size, home price appreciation, population growth, median income growth, median home sales price. We're going to compare different markets that have these qualities to the max. But, not only are you good at figuring out kind of like these rubrics and these scoreboards, you're also good at understanding the rules of the game. You know where the out of bounds is. You know when to throw a flag and call a 15-yard penalty out there.
There you go.
And you've establish a couple of red flags when it comes to looking at this stuff. What do you mean by red flags?
Well, what I mean is if you see a market that has some of these criteria that I'm going to share with you right now, mm-hmm. you can just throw it away. It's not something to be considered. It is not an ideal market for cash flow and growth. It's not an ideal market to maximize your return on investment. So that's what these red flags are. And I put 4 here. If you find a market, if you're considering a market and it has any of these criteria, mm-hmm. just throw it away. Just go and look for another market, okay? So rent to price ratio under 0.45%. What that means is we're looking at our rents on a monthly basis mm-hmm. and we're comparing that to the purchase price or the market value. It's just a simple, easy way to evaluate, hey, is this a market that I can potentially get positive cash flow in? Yeah. The higher the rent to price ratio, the better the chances that you'll have positive cash flow. And if you are under 0.45% here, you're not going to get positive cash flow. There's really no way to do it. So look for markets that if you are looking for markets to eliminate, it will be a market that has a rent to price ratio under 0.45%.
Got it.
Next, we're going to look at current population size. If you are looking at a market and has less than 1 million people living in that market, throw it away. Go to the next market. And here's why. This asset class is so beautiful. And part of the reasons it's beautiful is because it's so risk mitigated. Mm-hmm. It's not an asset class that you have to stay up wondering and thinking about what the news from the day is or what happened across the world that's going to affect your ability to deliver a return on investment. Mm-hmm. And that's why people love it. But here's one way that your plan can get thrown completely off course. If you invest in a market with a small number of people that also has a small number of employers or is focused just on one industry, one decision from the CEO of that company to go and switch locations or make a big change, or maybe that CEO does something they shouldn't do and that company doesn't have, it's not looking good going forward, that could throw your whole plan because that's the job base for your residents or your renters.
So like your town is like, that has one big employer, call it Callahan Auto Parts, and old man Callahan is moving on from the family business and moving to the factory. Your whole town is at risk.
But I think the best teaching lessons come from Tommy Boy and Chris Farley, right?
They should make a movie out of it. That makes sense. So this idea of under 1 million, that generally means like you're overweighted to like one market sector. Maybe it's not like one company. Maybe it's just like you depend solely on tourism, or you would depend solely on construction. These like boomer bust cycles that tend to happen. That's a risk as well.
There you go. So under 1 million, throw it out, go to the next one. Home price appreciation under 4%. So what I'm looking at here is the average annual home price appreciation rate over 40 plus years, because history is a predictor of future home price appreciation. If you have annual home price appreciation in your market that's under 4%, that means that market has grown substantially less than the national average. And there's a reason for that. People likely are not moving there. They're moving away from there over time. And there's something about that market that is probably unlikely to change. If you invest in markets that have under 4% home price appreciation, this is where you're leaving hundreds of thousands of dollars on the table, maybe millions of dollars over a full market cycle. So do not invest in markets that have under 4% average home price appreciation. And then lastly, median home sales price above 500K. If you have prices over 500K, you're not going to get cash flow. And it's also going to make it a lot harder to scale up, right? The goal here for many of us is to maybe build ourselves out of our active jobs, retire early, something that requires some scale, meaning you'll need 3, 5, 10, 20 properties. A lot harder to get there if each one is costing you $500,000 or more.
Yeah, that makes a lot of sense. You see, and when I think about these red flags, I think of rental property investing is a complex math equation, right? So we're going to have to look at the 6 different criteria, and you can look at the 6 different criteria across infinity towns in the United States, right? So it's like really useful to just have like okay, if this, then it's out, right? Like the smaller we can make the target to have less stuff to look through, the better it's going to be for ourselves, which is why I like these red flags. So my question to you, GC, is, given that there's no red flags, and given that home price appreciation is like the thing that you make your most money on, why isn't it just, let's just pick the number 1 market in home price appreciation?
This is a key concept, okay? So it is not about being the number 1 best market for some of these criteria. Because if you are the number 1 best market for, let's say, rent to price ratio, it is very likely that you're going to rank very low on another really important criteria, let's say home price appreciation. If you're really good at home price appreciation, it's unlikely that you're going to have a high rent to price ratio. So it's feast or famine. When you look for the market that is number 1 in one of these categories, you're likely leaving money on the table elsewhere. That's unfortunately why many people pay attention to some of these lists that are produced by some of these publications. Oh, this is the best market for X. What they're not sharing with you is that you're giving up this over here, and it's unlikely that you'll have the best returns over the 5 profit centers. So the key takeaway as we're going through this exercise today, guys, is the best market is the one that ranks above average in as many of these criteria as possible. It's not about being number 1. It's about being above average in as many of these as possible. That is the best place for you to invest.
Got it. And I'm going to ask you all to use the Q&A function to store this stuff, because we're trying to get through all this information. Then we're going to save some time for questions. And if it's in the chat, it kind of like flies through. So help me help you. Speaking of help me help you, Greg, I have a little analogy about this, like being number 1 in certain things. Do you mind if I share it?
Yes, I think I know where you're going.
So I think of rental property investing as getting married. This is a long-term relationship, right? Like you buy the home, you're going to have to own it for 30 years. I think any of us would be lucky to find a partner that we can be with for 30 years. And let's say that I'm looking at partners. Let's say this is my senior year of high school, and we're in one of those eras where we marry our sweetheart from high school, and that's normal. And I know that when I graduated high school, there was people that got voted most popular. There got people that got voted most athletic. There got people that got voted most likely to succeed, right? They got people that got voted funniest. And then there was someone that got voted best all around. And if I was somebody's father or mother or something like that, I think I'd want them to marry best all around, right? It's like you got the best chance to like be somebody that can handle tough times, be there for the good times, make you laugh when you need it, maybe, catch a game-winning touchdown because you're just athletic enough, stuff like that, right? So
Sneaky athletics, maybe.
Sneaky athletic, maybe, right? be able to make money as well, right? To
Okay.
support a good life, right? So you kind of want that well-rounded thing. I look at rental property markets and I think of, I want best all around. I don't just want most popular. I don't just want the class clown maybe, but I want best all around.
Yeah.
Yeah.
I think it plays. I think it
Okay.
plays because that's what we need to think about when we're looking at these criteria. And what I did was, by the way, amazing analogy, by the way.
Yeah.
I feel like we got a little
I've tried
sense.
this a couple of times.
I feel like we got a sense into your high school experience and we got some really good criteria for us to help make investment decision here. Here's what I did to kind of take that mentality and bring it to objective criteria for you to be able to make a decision on. I said, if I had a blank slate and I was thinking about where to put my money, let me go and find, using objective data, right? Let me go and find the best market for X. And then let me see if it is giving anything up for the other profit centers. Yeah. And so that's what we did before the show. We went through all of the top 99 US metros out there. And we said, all right, which one ranked for highest this, highest that, highest this? Now we're going to go through, we're going to share all that data with you, and we're going to show you which ones are more balanced, which ones are maybe funniest, but maybe can't make money, or can make money but can't hold a conversation. I mean, it's lucky that you're not that guy at all. So
so let's start with the valedictorian, shall we? We'll go with home price appreciation, since we said how valuable that is. GC, number one in home price appreciation.
So that would be San Jose, California. If we have some folks from San Jose, chime in the chat there. San Jose, California is actually the highest home price appreciation market in the entire US over the last 40 years.
Silicon Valley, that's why a market matters, right?
There you go. There you go. So there are some things that it does very well, like high home price appreciation, high growth, but there are some things that are major challenges if you're going to invest in rental properties in San Jose. Number one, look at that median sales price. It's the only one that I put up there with an M.
$1.9 million median sales price. That sounds like a red flag to me.
$1.9 million. That's going to be really, really hard to make positive cash flow. And that's related to the rent to price ratio at 0.22%. You're not getting positive cash flow in San Jose.
Yeah. So two red flags, $1.9 million, 0.22% rent to price ratio. Down here in Jacksonville, where you have the majority of your investments, GC, we see 3.6%. 0.51 and 4.8 home price appreciation.
It's good to give you context for what the national average is. And then obviously I advocate for the Jacksonville market. So I want you to see how in my mind, I make that decision to continue to invest in Jacksonville.
So so the red flags, high purchase prices, right? That's a red flag. Negative cash flow, low home price to price ratio. I whistle that one, it's out.
There you go,
right?
It's out.
So next, rent to price ratio. This one is sexy, right? Like this might be most popular.
There you go. There you go. I like it. You know, I don't know. I think most popular would probably be population growth, but you know what? We'll go with it, right?
I make the rules here. You make the scorecard. I make the
Detroit, Michigan comes in as the highest rent to price ratio market currently. Detroit's median home sales price. Look at that one. That's really nice, huh?
Pretty nice. 155.
I'll
take a handful.
Only $155,000. Yeah. Right. Look at the rent to price ratio, 0.82%.
Beautiful.
Right. If you invest in Detroit, you're likely going to get significant positive cash flow. But what are you going to give up?
Looks like population growth looks pretty scary here.
Population growth is pretty scary. Population growth is an indicator of future growth, of future home price appreciation. Over the last 10 years, people have been leaving Detroit. Yeah. Okay. That's not a good sign because population growth is needed to drive significant housing demand, increase home prices, increase rents, increase median incomes. You're just not seeing that in Detroit. Yeah. And you also see this in a backward looking statement too, because you look at the historical home price appreciation at 4%, it just barely made the cut there. Yeah. But what we need to understand is that just 0.5% or 1% off of what the US average is for home price appreciation is a big deal because these are assets that cost $150,000, $250,000 that you're holding on to for a full market cycle, which is between 10 to 20 years. It adds up to hundreds of thousands of dollars and millions of dollars. Yeah. So it just barely made the cut for home price appreciation, just barely on the very bottom rung, and rent price appreciation is well below the national average as well. Yeah. So the red flags for Detroit would be low growth today, what has happened in the past, low growth, and then future looking, you're seeing declining. You're seeing declining populations. Yeah. You can make an argument that it's going to be lower going forward if you're looking at the amount of population leaving.
Yeah, it's hard to make a lot of money if you sell fax machines right now. right? Like a shrinking market. Like you can be the best operator in the world,
Mhm.
and a shrinking market is really, really hard to do well in, right? Like
Mhm.
if you have this declining population, you have this low rent growth, right? Those are things that are red flags to me of thinking about getting into. Then there is highest median income growth. This might be most outgoing.
Ooh, I like that.
Yeah, I like that.
There we go. So highest median income growth would be Visalia, California,
Visalia.
which I had never heard of Visalia, California before.
I had it, and I thought it was Vidalia.
You did,
The onion.
you did the last
Yeah.
time that we talked about
Yeah.
this. Honestly, there's a lot to like about Visalia, but there's one major red flag,
What's that?
and it's a big one. The major red flag is the population size. All right. And the population growth rate, which is lower than the national average. So less than 500,000 people live in Visalia, and it's not growing. The chances that you get to 1 million people anytime soon, very, very slim. And you are highly dependent upon that industry there,
Yeah.
which is not growing.
Yeah.
So median incomes have grown. We like that. But there's some reason that people are just not moving to Visalia.
Yeah.
And what that's going to do is it's going to dampen home price appreciation, rent price appreciation. And what that will do is, again, leave you with leaving money on the table.
Yeah, I would also assume that a small market means that these like stats of like growth and stuff get tweaked by like small numbers, right? Like when I started my company and I had 2 clients, I got one more client, I grew by 50%.
Right.
Not nearly as impressive as you with 2,000 clients growing by 50%. Right. So that's a completely different kind of like scale. I think of these towns like Visalia. You know, I lived in Southern California in the early 2000s. I moved to Riverside, California. And that back then was like all these folks that were living in the big cities in LA and Orange County, kind of like being willing to commute punch yourself in the face, painfully long 2.5 hour commute each way
Right.
in order to get lower home prices. But then when things didn't go so well in 2008, 2009, those areas took it in the teeth, right? We see that
Yep.
in small towns in Florida as well, right? So this idea of a small population, even if median income is rising right now, you know, there's a lot, chances are it's not supported by a bunch of different industries and looking for that stability you're looking for over the long term.
Right. It's too great of a risk. You're
Yeah.
getting in this to be risk mitigated. There are populations out there over 1 million people. You don't have to assume the systemic risk that you face by investing in a population less than 1 million, which is what Visalia
Got
would
it.
be.
So let's talk about highest population growth. Is this the one? Yeah,
This is most popular.
popular. Okay, fine. It's gonna be most popular.
So the highest population growth over the last 10 years is Myrtle Beach, South Carolina. We like high population growth. There's a lot of other good things to like about investing in Myrtle Beach. For one, the median home sales price is lower than the national average,
Pretty good.
right? They have nice home price appreciation. Rent price appreciation looks good.
Yeah.
They have nice median income growth as well.
Yeah.
Here's the challenge.
Yeah.
Population again.
Super small population.
Under 500,000 people living there.
Yeah.
And I think your point about low numbers making it easier to look good on a percentage basis is really applies to Myrtle Beach.
Yeah.
It's going to be very hard for Myrtle Beach to continue to be the highest population growth as their numbers increase, but it's going to take a long time for them to get to 1 million people.
Yeah. Michelle's saying that's why they call it Dirty Myrtle. I'm just kidding. I'm just kidding. She didn't say that. She just said that they call it Dirty Myrtle because Michelle's from close to that area. But yeah, the red flags in Myrtle Beach are population less than 1 million, right? This idea of these like short term, you know, there's like the easiness to like move statistics around when there's small numbers. That's something to look out for. A town that means that, you know, Myrtle Beach in particular, probably heavily based on tourism economy. Right. When times are hard, those are the dollars that go away.
Right.
Right. So, you know,
too much systemic risk.
Too much systemic risk. All right, cool. So let's talk about these #1 ranking markets in the U.S.
So this is where we can visually see what is a market really great at? Yeah. What is it leaving on the table? Yeah. Low numbers are better here. When you see low numbers, that's what we want to see. But look at like San Jose, for example, as an example. Home price appreciation, they're #1, like we talked about. They are number 99 when it comes to the highest median home sales price, right? You can look at other examples. Detroit, Michigan, #1 for median home sales price. But look, they're number 75 when it comes to home price appreciation. They're number 69 for median income growth. Right? They're number 95 for population growth. So the indicators of growth today and the indicators for growth in the future are not looking good. You can go on down the line here. There are some that look pretty good. Myrtle Beach actually has 1, 2, 3, 4, 5 out of the 6, but they have a deal breaker. That 1 million people current population is a deal breaker. And that's why we wouldn't advocate for Myrtle Beach, South Carolina, too much systemic risk. But here's where Jacksonville thrives. And this is the only market in the country that ranks in the top 6, on the top half, for all 6 of these criteria. You can see we're not number 1 for any of these, but we are consistently above average in all of them. And what that allows you to do is to maximize all 5 profit centers and to end up at the end of the day having a bigger profit pie after a full market cycle.
Got it. So best all around is this idea that you rank well in all these categories, right? You might not win the 100-meter race, but you win the decathlon, right? And over a long period of time, which is what rental property investing is, and you need to be in a long period of time to receive home price appreciation and all the benefits that you get, you want to be able to outlast all these kinds of like things that happen in rental property investing.
Exactly.
Got it.
Exactly. And this is the type of analysis I would encourage either you to do on your own or reach out to JWB to allow us to help you make an informed decision, or rely on your Fortune Builders Passive Income Club to help you make this decision. You have so many resources. Now, guys, we pay for this data. That's how I was able to compile it. You can find this data yourself in many free sources out there, but don't just go and invest just because it's in your backyard. Put this thoughtful analysis together to know how you're going to grow your profit pie, not just today, but over a full market cycle.
GC, I have a question. You said that you own 400 rental properties. Where are they?
They are here in Jacksonville, Florida.
Is that because you knew all this stuff coming into it?
I would like to say that. No, I started to invest in 2006. I was fresh out of college. I worked in corporate America for a year. I found Than, I found Paul. I said, these are the guys that I want to invest and be like. But no, I didn't know this before I started. I feel very lucky that I landed here, but the data speaks for itself. As I've become an expert, I know what to look at. As I've seen how over $1 billion in real estate actually works. I've grown to understand this, and I feel very, very lucky and blessed that not only do we only invest here in Jacksonville, Florida for our single family homes, but that's the only place that our clients invest as well. It's because we do believe, and the data shows that it is the most balanced, the best market for producing on all 5 profit centers.
Yeah, I think there's 2 things to be said about that, right? Like, apart from that you got lucky in 2006 and not go completely broke, but I think success leaves clues, right? Like, I think this idea that you've been able to build this like one-of-a-kind business in Jacksonville has a lot to do with the fact that you and your partners are really great operators, right? Like there's no doubt about that. You guys are phenomenal entrepreneurs, but you've been helped by this really resilient economy that's been here for 20 years and will continue to be here and continues to rank as like one of the cities where, #1 in corporate relocations and second hottest job market in the Wall Street Journal, one of the 10 fastest growing cities. ULI calls it a supernova city. Like these kinds of things really help buoy all these things. And then the other thing that I like is I like doing business, especially with service businesses, I like doing business with people that eat their own dog food. I have a hard time, as somebody that owns a marketing agency, I have a hard time doing business with a marketing agency that isn't out there doing their own marketing as well.
100%.
And like learning from it.
Yeah,
right?
it's one of the most time-tested, proven ways to make sure that goals are aligned. If somebody is doing what they're advocating for you to buy from them, your chances of success are a whole lot higher.
100%. So that is just, you can download this JWB Jacksonville Real Estate Market Report Q2, Q3. We put this together. You want to show me what this looks like, GC? So this is an asset that we have created for everybody to get more familiar with the Jacksonville market.
Pages is this thing? 3,500 pages or something like that. It's we put our heart and soul into this. It's something that I prepare quarterly to inform our clients and the real estate community here in Jacksonville. And we created this magazine style report. It's something that you guys can download. I know we only have an hour here today. So if you would like a deep dive into what are prices doing in Jacksonville, what are rents doing, what are the economic drivers today, how are we set up for 2025, and then looking forward for Jacksonville, would highly encourage you. It's free for everybody here. And you can go to jwbrealestatecapital.com/FB, or you can just scan the code there if you're a super high-techy folk, and then you can just download this report.
And one of the key insights from that report is something that's happening in Jacksonville that we've uncovered through the data that has us really, really excited, right? Like all this picture, everything that we just talked about is something that just is, but there is some insider information in that report that I think we should share a little bit of right now, right?
I'm super passionate to share it. Let's talk a little bit about what's going on in downtown Jacksonville, because not only do we believe, just by the data and the numbers that I shared with you previously, that Jacksonville is the place to invest, we also believe that Jacksonville is the next great American downtown.
Why does that matter, GC?
It matters because if you want a tip on how to maximize your return on investment, more than any tip about what's the next shopping center to come next to your property, or the next great school system, or the next amenity, the greatest tip that anybody can give you that will maximize your return on investment is finding the next great American downtown and then owning single family rental properties right around that downtown. And I say that because the data, of course, speaks for itself there as well. I've looked and I have the research to show that revitalized downtown cities appreciate a lot more than the US average. Since 2005, revitalized downtown cities have appreciated 89% more than the US average. And we're talking about cities that many of you maybe live in or think very highly of. Maybe you go and you visit like I do.
Yeah.
I've gone to Austin, I've gone to Nashville, I've gone to Denver, I've gone to Tampa, right? These are places that people want to go. But guess what? People weren't going there 20 years ago to go and hang out and bring their families. And when that happens, you maximize your return on investment, but you don't have to take more risk because these properties cash flow if you buy properties surrounding the next great American downtown.
Yeah, and you've had this data here that shows this like rise in these cities of national. I think everybody on this call, whether you're a savvy real estate investor or not, if you're asked, I wish I would have, would you have liked to have bought property in Nashville, Austin, or Tampa in 2005? It's a resounding yes.
100%.
Right? And what I think people would be surprised to know is that these cities all had very similar home prices as Jacksonville had 20 years ago.
Actually lower than Jacksonville 20 years ago, but something changed. And now their home prices, like Nashville is a great example, $147,000 in 2005. You could get positive cash flow for single family rental properties around downtown Nashville. Now the median home sales price is about $467,000. You are not able to get positive cash flow. Therefore, this beautiful risk mitigated model doesn't work in Nashville anymore. So what do these cities have in common? Well, each of them have a downtown that was revitalized in the early 2010s.
Let's talk about what makes a downtown revitalized, GC. This is one of my favorite stats. This idea that we found this metric that shows that when downtowns hit 10,000 residents in their urban core, they change the designation from going from an 8-hour city, which means you go into downtown Monday through Friday, you do your work, you get out. That's what Miami was when I grew up in Miami, to a 16-hour city, meaning people live, work, play, and travel to downtown as an amenity, which is what Miami is now that I no longer live there. And this happens because to get a functional downtown, I know we got people from South Carolina here, right? Like South Carolina, Greenville has a very functional downtown because it has a lot of this like mixed use development that was foreseen by a mayor 25 years ago. It wasn't done just like, by happenstance. When it happens by happenstance is when developers come in, they need to develop these mixed use projects. The one thing that they need is anchor tenants. They need the big box, like the bigger stores, the Whole Foods of the world, the Publixes of the world, the Ralphs of the world, to say, yes, we will take a majority of the lease so that you can build the condos above it and a parking garage and all this like cool stuff. And they look for 10,000 residents. Before that, the city has to have the foresight, like Greenville did, to create these incentives like Jacksonville have also done. And what we're finding is that Jacksonville right now is on the precipice of this line of demarcation.
Absolutely. If we know that the next great American downtown is the best thing that you can look for to increase your risk-adjusted returns on investment, then think of this number of residents living downtown as that leading indicator. And if we understand that successful downtowns, when they cross 10,000 residents living downtown, developers want to come in. All of those great grocery stores that you just talked about, those anchor tenants, they want to come in. They know this metric. Then we can say, all right, what's the best time for me as an everyday investor to start to build my rental portfolio? What would have indicated to me in Nashville in the early 2010s that I should have been buying cash flowing rental properties there? Because if you go and you work your way backwards, buying cash flowing rental properties in Nashville over the last 20 years would have been the best risk adjusted return on investment anywhere in the country. So how do we find that? What leading indicators? Well, we're going to look at some of these case studies here very quickly. And again, we won't have enough time to go through this in detail. So I would highly encourage you to reach out to JWB, reach out to Fortune Builders through our Passive Income Club, and get on the phone with us if you'd like to talk more about this. But what you're going to see is we've been able to pinpoint when was the exact time that those downtowns exploded, and then what happened with that total growth,
as it were.
There you go.
Yeah.
So in Austin, Texas, it was about 7,600 residents downtown was the start of rapid growth. After 7,600 residents, downtown Austin doubled just from 2010 to 2024. This number of people living downtown. Now they have over 15,000 residents. And look at their skyline. Pablo, what do you see here?
I mean, I see from like a smattering of a couple of buildings to like some real density down here.
I can tell you firsthand.
Clusters of density.
I just went to go and take my family to spring break in Austin, and we loved it. And there was so much fun stuff to do downtown, and it just didn't look that way in 2012, as you can see from the pictures here.
So let's look at Nashville, man. We talk about Nashville all the time.
Nashville as well. For Nashville, it was about 7,300 residents downtown was the start of rapid growth. The numbers are even more impressive. In downtown Nashville, once they reached 7,300 residents, it grew, the number of residents grew 174% just from 2013 to 2024. And look at the skyline here.
Unbelievable, right? Just like a couple of buildings to like a whole city of buildings.
It's like a sleepy downtown
Yeah.
to almost a sliver of, you call it one of the most successful downtowns.
Absolutely. Absolutely. So then let's look at what's happening in Jacksonville right now, GC.
So this is the parallel to Jacksonville and why we believe that Jacksonville will be the next great American downtown is guess what? We have about 7,600 residents living in downtown Jacksonville, and it has grown 47% in the last 6 years. Our resident population is expected to grow 135% by the year 2030, a very similar trajectory to what we have seen in Nashville. And I know all of you are not experts in downtown Jacksonville, but I just want you to get a visual for all the projects that are happening right now. There's over $5 billion in active development. That means cranes are here, dirt is moving, things are happening. Like, for example, we have a $1.44 billion stadium project. Our Jacksonville Jaguars are getting their stadium redone. That's already been approved by the NFL and by City Council, and that'll be done by 2028. We also have the University of Florida highlighted on that side, on the west here. The University of Florida is bringing a 10,000 student graduate campus that is focused on IT, healthcare. We have the largest supercomputer. AI supercomputer at the University of Florida. We're bringing a graduate campus. It is happening right now. It is not theory.
Fintech and healthcare.
If you want to talk to somebody from Austin about what changed the trajectory of downtown Austin, University of Texas and the confluence of the IT, boom. Yeah. Because then all of those UT grads stayed right in downtown Austin, made great incomes, and the rest is history. And that's similar to what we have happening in downtown Jacksonville.
I love it. And if you think back at those pictures, right, this density starts to really fill in by these clusters, right? And the Stadium of the Future, funded by Shad Khan, a billionaire, he's also funding all these projects over here called the Shipyards and a Four Seasons and a whole other thing. And then there is something called the Pearl District, which is something that JWB is leading the path with here.
So Gateway Jacks is a project that JWB stood up. We started the Gateway Jacks project and would encourage you to Google Gateway Jacks. If you want to learn more, there's 1,000 articles written about it.
The TLDR is Greg and his partners have bought 20 city blocks of downtown Jacksonville and are placemaking. They're building one of these like mixed use hospitality and residential and office and public spaces and retail and all this type of stuff to create the density that's needed in order to make downtown reach this tipping point. And you've really been like the tip of the spear of leading this effort, not so much because these downtown offerings make sense for average investors like ourselves or fortune builders, but because that if this happens in a downtown, then all the single family homes, the 6,000 single family homes that people have invested in with you around Jacksonville, then those all benefit from this home price appreciation.
Exactly.
So this is the stuff that's happening right now in that Pearl Street district, and befores and afters and the density that's going to happen. And these are the 6,000 homes that JWB offers folks that are all going to benefit from this buoyant force from this market explosion in downtown Jacksonville in a market that's already working really, really well.
Exactly. If you could go back in time and ask yourself, would you think it would be a good idea to go back to 2005, invest in Nashville? How many rental properties would you buy? You'd buy as many as you could. You would have been the smartest guy or girl in the room. And that's really the opportunity that we see in Jacksonville now. It's the ability to buy cash flow positive properties, but don't do it in downtown. It's too risky.
Yeah.
I'm investing in downtown. You don't want to do that, right? It's a different risk profile right now. There's different wins for me as a downtown investor. You want passive, you want risk mitigated, you want positive cash flow, but you also want to get the growth of the downtown that is blossoming. Well, you can do that by owning these single family rental properties, just like you see on the screen, around downtown. And that is the unique value proposition that we advocate for at JWB that our clients are taking advantage of and through the Passive Income Club. And that's really the opportunity that we want to share with all of you as well.
And we're going to get into Q&A right now, but if you want to know more about that downtown and the state of the market, again, grab this thing. It's awesome. Let's jump into Q&A before we wrap up here, GC, because we got some good questions in here. We got Bill Mosley. He says, I have 2 single-family home investments in Kansas City, Missouri. I know I have received info from you folks. My question is, I have an 800 plus FICO score, not sure how that happened, and not that much cash on hand to acquire more property. How can I take that 800 plus FICO score and trot it out to see what it could do? Preferably not having to cash out current properties. Thanks, great webinar.
Wonderful. Well, there's a lot of opportunities that you have to do this. I would highly encourage you, Bill, to get on the phone with our team. We'll be able to put a plan together for you. So this is a very common thing. We have folks that own properties in other markets that are considering either selling those assets and bringing it over to JWB in Jacksonville, or they want to keep the assets. There's a strategy for both. You know you have a great credit score. That is a tool for you. The first thing I would look at is, let's see how much equity you have built up in those assets that you have, I believe in Kansas City, if I remember correctly,
City, yeah.
right? Let's think if we can do a cash out refinance or maybe a home equity line of credit, which are available on investment properties. And let's see if you can now build a diversified portfolio, not only in Kansas City, but one which is in a growth market like Jacksonville. So a lot of opportunities there, Bill. Reach out to us here, 904-677-6777 is our phone number. Or probably the best thing to do, Bill, is just go to jwbrealestatecapital.com/FB and then schedule a time to speak with the team.
I just want to iterate that analysis like this that Greg just offered, Bill, because you're a Fortune Builders client. This is already included in your membership to Fortune Builders. Everybody on this call can schedule this, schedule a call with JWB, and they will walk you through all of your options, tell you what you have available, like talk you through into understanding what you have available to invest, understand your goals, understand how you can build the best portfolio possible for your passive income goals as well. So that's just an open invite to anybody to hop on this call. It's already part of something that you have offered to you, and Fortune Builders has already kind of like made the recommendation that this is the way to do it, right? So okay, we got another one here. Home price appreciation, what period of time, GC? Where do you get these stats?
Great question. When you're analyzing home price appreciation, it is important that you look back as far as possible. Do not fall into the trap of looking at what home price appreciation has been the last 3 years or 5 years. So the data that you should be referencing should go back over 40 years. This data, it's available. The data I shared with you is referencing over the last 40 plus years. But there's data that's available. If you just go to the Federal Reserve banks, they many times have data going back to, even the 60s. It's free data. So I would highly encourage you to go to the Federal Reserve banks. So type in FRED and type in home price appreciation rates. You can look up your market. Other great sites would be the U.S. Census if you want to start to see population growth. And you can also go to the Federal Housing Finance Agency sites. Do this due diligence and do it over a long period of time, 40 years if you can get access to the data. That's going to give you confidence to know the right market that you think about investing in the future.
I'm glad you brought up where you get some of this data from, because Emily Green had asked, where do you find these metrics? Those sources that you just described, is that where you're getting all this data from?
I pay for the data. We pay for the data here at JWB. But for most investors, you're not going to pay for that data. It's quite expensive. So what I would recommend for you is, like I said, those free sources. Again, Federal Reserve banks that provide this data. There's a number of them across the country. So just type in FRED or Federal Reserve Bank, highest home price appreciation markets or home price appreciation. Same thing. Federal Housing Finance Agency is another site you can go to that's free, and then the U.S. Census.
Yeah, I mean, is it worth saying that they've essentially joined Fortune Builders to have partners like you that have this data that can do these types of analysis for them, so you can just kind of like give us a
Absolutely.
call and get on it?
Absolutely. If you're in a position where you're thinking about investing in another market, or you're like Bill earlier, who is already invested in another market,
Yeah.
wants to keep the assets, but maybe wants to make a decision to come to a more balanced market like Jacksonville in the future, it's a great time to jump on the phone with us. If you have a market in mind and you're already investing there, we're happy to give you the high level details of that market. Now, what we can't do is we can't take 1,000 requests over text from everybody saying, hey, can you prepare a market analysis for Sheboygan? Not able to do that. So if you do want to learn more about the market you're investing in or your own backyard, it can start with a phone call with JWB, and we'd be happy to share some of this data that we receive and pay for from our consultants and share with you to help you make a more informed decision.
Sounds good. Michelle Enerson has a question. Can you put a HELOC on a property held in a solo 401k?
That's a really good question. I'm not 100% sure. And rather than giving you an answer that I'm not 100% sure on, I'd rather, I know that I'm one phone call away. My team is one phone call away from the answer. So what I would encourage you, reach out to the team. We can get that answer for you very quickly. That is a great question. I just don't 100% know it right now.
Got it. Monica Cumming asked, do these criteria apply to short-term rentals or just long-term rentals?
These criteria apply to long-term rental properties. Thank you so much for the opportunity to clarify that. Short-term rentals have a completely different risk profile. It is a completely different asset. It sounds similar because it's rental property, but many investors have learned that there's very different risks to think about.
Regulatory risks, they are one part of the tourism economy. So like where the tourism economy goes, the short-term rental market goes. And then at the end of the day, you're counting on a very different maintenance and turn and like operational, like heavy lift that makes this a very different game.
And 5 years ago, it was all the rage to invest in short-term rentals. That changed a lot with the regulation risk that you talked about as interest rates have gone up. And really what we have seen with our own money, because we have never sold a short-term rental, but we wanted to explore it. So we invested over $5 million of our own money in short-term rentals. We still own those today and have been able to see a side-by-side comparison. And, the promise of short-term rentals has not been realized for a lot of investors out there, and it hasn't been realized for us. A lot of work, a lot of additional turnover, a lot of additional fees to spend on performing all of that work or maintenance or turnover and things like that. And ultimately, we're seeing less cash flow with way more work than long-term rentals. So that was just a case study for our own internal. I would advise you to think about that as well.
And your case study is in a market that has stayed friendly to short-term rentals.
That is true.
Of Jacksonville, right?
Correct.
We are a low regulation market, very investor friendly. So this has been a good market for short-term rentals. People come here to go to the beach, all that stuff, right? Like, so this does not count the New Yorks of the world and the different places where people have gotten in and all of a sudden like people just don't want it in their backyard, right? Like societal changes have affected that market in a way that we couldn't have foreseen because it hasn't been around as long as.
And that's what we talked about 5 years ago. Yeah. And people were asking us over and over, can you sell short-term rentals? Can you sell short-term rentals? And my answer was, we're going to test it with our own money first. And that's the value of you working within the Passive Income Club, being a part of Fortune Builders. That's the value of the connection between JWB. Fortune Builders would not recommend for you to invest with a company like JWB unless they did business that way, where they tried it out with their own money first. As I mentioned, short-term rentals is not something that we've ever sold, and we're not going to.
Suvi Joshi has a question. What do you see for insurance costs for like a 2,000 square foot single family rental property? Aren't insurance costs much higher in Florida?
Oh, I'm so glad that we get that question. So many misconceptions about insurance in Florida. The insurance market overall has actually stabilized in Florida, which is a great thing. But even more misconceptions. Everybody thinks every property in Florida has a high insurance cost. Jacksonville actually has much lower insurance costs than the rest of the state because we're naturally protected from hurricanes. We have never had a major hit from a hurricane in Florida, which is knock on wood. And I'm sorry, in Jacksonville, Florida. Right. Thank you. But here's the other thing. To answer your question directly, our average insurance premium for a new construction JWB rental property, only $700 for the year.
For the year.
$700 for the year, the average insurance premium for a new construction home. So new construction is something we focus on, and that is a great way to get positive cash flow. And of course, insurance rates are a lot lower than what you might expect.
Ask me what happened in my last insurance renewal, Greg.
What happened in your last insurance?
It went down.
That's true. That's true. We are seeing that. We're seeing more insurers come back into the state. We're seeing more competition. We are hopeful to see insurance rates go down. It is happening.
It is happening.
It is happening.
Yeah, it's not for everybody, but it is happening.
There you go.
For one of my properties. Long story short is there was this kind of like litigious environment that happened because of there was like a loop that lawyers and roofers were getting put together on a few years back. That drove insurance costs crazy. A group of folks went up, lobbied. They realized it was bad for the market. They changed that rule because we were down to one insurance provider. And in the last 3 years, we've seen multiple providers come back into the state of Florida. Competition is good for the consumer. And what we're seeing is stabilizing and generally dropping insurance rates, at least for me.
There you go.
So that being said, Waverly Parker says, how do you calculate rent to price ratio?
That's a great question. So if I'm just going to use easy numbers that aren't actually applicable right now, but it's just easy. Let's say that the purchase price of the home was $100,000. Again, not real, right? Homes in Jacksonville cost $250,000. But let's just say $100,000. That would be 0.45% would be rent of $450 a month. Mm-hmm. So you're comparing your rent to the purchase price of the home. So hopefully that helps you.
Yep, there you go. Antonia Gray Fenton says, what are your thoughts on vacation rental? I feel like we just answered that with a short-term rental.
I think so.
And all right, let's end on this one. This is an interesting question. Somebody anonymous is saying, in my current state of life, I make minimum wage and have little saving. I'm working on creating more income so I can get a passive income property. What goal should I set for saving up? I'm only 30, but I would like to save up with a goal. GC, you've been really good about doing this in your life.
I'm so happy that you're here, that you're on this call, that you are courageous to put a question in like that. The fact that you're here right now is honestly the best investment you can make. The goals that I would set if I were you is the same goals I set for myself is, how do I find mentors? How do I find people who have accomplished this? How do I take those people out to lunch? How do I get in their circle? Yeah. How do I surround myself with more trainings like this? And you'll be able to, that will be your greatest growth path. In terms of a dollar amount that you can save up, I would, yes, there's a dollar amount, right? And a typical property for JWB might have somewhere between $50,000 to $75,000 required to invest. But I don't want that to trip you up, right? Here's what you need to think. Open your mind to think about all of the ways that you can invest. Yeah. When I first started, my first deal that I ever did was a partnership because I didn't have any money. But I had a lot of hustle that I was willing to offer. I had a good credit score at that time. And there was a partnership that I was able to create. You might be able to bring some value to some other partnership as well because you're accessing world-class training as a part of the Fortune Builders Group. You might have a great credit score. You might be able to take on the loan. So think a little bit beyond how much money do I have to save up. Surround yourself with folks who have accomplished what you hope to accomplish. And I bet you'll get there even faster than if you figured out what is $50,000 divided by how many years and all that. So I just love that question. Thank you so much. I think it's a great way to end.
I think it's a great way to end. It just reminds me of how I got started here. Like, I never thought of myself as somebody that'd be a real estate investor. And then I started hosting the show, surrounded with you and the folks that come to our show every Tuesday, which, by the way, you are invited to join us every single Tuesday. Whoever it is that put in that question, or any of y'all, if you like this information you're getting, every single Tuesday we go live from this same exact studio and talk about rental property investing concepts that that have worked for others, that work for you, and all things that educate you on ongoing education on this type of stuff. But when you surround yourself with people, I like to call it cognitive bias, right? Like, there's nothing more powerful than seeing somebody just like you that has accomplished a thing, or maybe not like you, maybe close to you, but like less smart than you are, or has less hustle than you have, or something like that. And they've accomplished the goal that you are trying to, and you're getting stuck on, right? If you surround yourself with the right people, it just tends to happen. I find it happened for me. Like, I would have never thought that this would happen. I now, 5 years later, have 5 properties. I would have never, seen myself as somebody that owned a rental portfolio while building my business, all totally passive. And it's just kind of magical that way. Greg likes to say kind of like the money is kind of like it's one of the easiest things to overcome, because if you surround yourself with the right people and you show up time and time again, as a person that is serious, has follow through, they will give you opportunities. They will lend you money if you bring them deals. They will partner with you on deals and the things that you're talking about. That just tends to happen as long as you have the right network. It's just kind of like the giant shortcut for everything, right?
There you go. I mean, I'm a walking testament to it as well. That's why I invested with Fortune Builders in the very beginning. It was a little bit about the education, but I got to share with you, in 2006, when I started, there wasn't a built-out education platform.
Yeah.
It was so that I could surround myself with Than,
Yeah.
with Paul, with the entire team. And, you know, it's been 20 years of an incredible journey because of that investment.
Great place to end, GC. I applaud each and every one of you for showing up to this call. I applaud you even more for joining Fortune Builders, for surrounding yourself with the right people that are doing the things that you want to be doing. Welcome to our community here at the Not Your Average Invest Show. We hope that you join us this Tuesday coming up, when we have actually the guy that is the head of development for that, the CEO of Gateway Jacks, that big project that we were just talking about. We're going to interview him about all the things that are happening in downtown Jacksonville. We've had him on the show before. Super dynamic guy that's done this in Tampa, that's done this in Washington, D.C. So personally, I'd love to invite you to that show. And we have one little piece of advice we like to leave people with before we sign off on every show. What is it, GC?
Don't be average.
Hope to see you on Tuesday.
See
Thank you
ya.
for coming.